about Persistent Systems in that list. Sarmas, thank you so much for joining us. It is under pressure post its Q1 numbers. Their revenue came in above street estimates, but profit declined and margin contracted sequentially. My colleague Reema spoke to Sandeep Kalra, the CEO of Persistent Systems, and began by asking about the one-off adjustments to the margin. Let's listen into that conversation.
Roughly, they will be in the range of about 150 to 200 basis points if we adjust for all of these things. Because look, if you are growing at 5.6% quarter on quarter, you are also winning larger deals where you are doing transitions which are there. You're doing vendor consolidation which are there. So it's not just a simple mathematics when you're running a company that you basically say, okay, this here and so on and so forth. So it's basically a longer range play where you are winning newer contracts, you are baking in all of those transitions, you're baking in all the optimizations, and then you're looking at a longer range. How do you claw back the margins?
Do you think, there is a possibility, or is the company winning deals by being more aggressive? Is that why maybe your margins are under pressure? Or do you think you've been winning it at the same margins as before?
So it is a fact of life in IT services industry. When you're winning larger deals, when you're doing vendor consolidation, the first 2-3 quarters, when you're even transitioning, the margins take a hit. And that's there for every one of our peers. And so I don't think there is anything, as I said before, to be overtly worried about. And I think there are so many good things that are happening in the company, and we stand by our aspiration of delivering industry leading growth with the profitability same as the last year. So I don't think there should be much concern there.
Okay, so let's talk about the good things then, right? Your revenue growth at 5.6% is the best that we've seen in the last 7 quarters and industry leading, as you pointed out. Is there a turn in the sentiment? Because this is the best in the last nearly 2 years now.
So look, there is small turn in the sentiment. I wouldn't say that this is because of the turn in the sentiment. The turn in the sentiment is people are expecting that over the next quarter to 2 quarters, starting September, maybe there's a rate decrease that happens from an interest rate perspective. And so there are positive green shoots in terms of discussions, not in terms of order wins because of a positive turn there. It's more about proactive proposals from our side. It's more about us scaling up, delivering more value, bringing platform-based solutions based on AI and so on. That's where we are winning. And just for the record, while we talked about the margins, etc., this is the 17th sequential quarter of growth, which is the highest in the Indian IT industry. The last record for that, from what we know, is 16 quarters at best, including the likes of some of the largest multinationals. So from that perspective, Persistent has delivered consistently based on our capabilities, based on our proactive proposals, based on our platform build, the AI play that we have, and that's what is holding us in good state.
Just in the near term, how is Q2 shaping up? Do you think growth will be similar to Q1?
You know fairly well we don't give forward-looking guidance, but I'm sure any smart person can look at the order wins, convert that into revenues, look at our total contract value wins that we have been announcing. So if anyone translates our ACV, the annual contract value bookings, to revenue, adds the multi-year deals that we have won, the answer is there. Balance will let the quarters pan out.
Okay. Some of your peers are calling out green shoots, particularly in BFSI in North America. And BFSI has done very well for you, a 7.5% growth. And even the run rate has hit $100 million. Talk about BFSI in particular. What has changed in the last 3 months for you? And what do you expect? What is the visibility on BFSI growth?
Right. So BFSI for us has panned out very well. It is based on both winning new business in existing accounts, some large accounts that we have, and opening newer accounts at scale against some of our tier 1 peers in the industry. So what is happening is, on one side, there is demand that is kind of starting to slowly move the needle. The other side is where companies are looking for, or the customers are looking for, partners who are bringing fresh thinking, who are bringing a platform-based delivery approach to services, not just human-based approach, so that they can save money from business as usual, deploy into next generation capabilities as Gen AI. And that's what has helped us in some of the largest customers and prospects, both in North America and even in regions like Australia, New Zealand, and India. So that's where we are seeing bigger wins, better wins against peers our size and bigger.
You said there's a small turn in the sentiment. Where exactly are we seeing it? Which category, which geographies, which verticals?
Yeah, so from an overall perspective, if I look at it, North America is the biggest market for us. And thankfully, North America is seeing a little bit more positive sentiment than the Europe side of it. Europe is yet to, at least for us, emerge as a bigger green shoot. So if you look at our growth, it's coming predominantly on the back of the growth in North America, growth in places like India and Australia. That is what is leading for us in terms of the growth side.
Okay. Coming back to that point about margin and the fact that FY25 margins will be similar to FY24.
Yeah.
Now, Q1 has had a drop of about 50 basis points. Q2 will have a wage impact, which will again further take away from your margin. So can you take us through the math on how you will be able to end the year with flat margins, and what will be the negative hit on your margins due to wages next quarter?
Sure. So let me give you the simple answer first, and then I'll do the maths. The simple answer is on the wage front, 150 to 200 basis points is the impact from a negative, margin perspective as we increase the wages. And thankfully for us, we have been genuine to our employees. We have not deferred the wage increase. A lot of our peers have. If we did that, we could have maintained our margins by 150, 200 basis points, but that's not the right way to do business. So 150 to 200 basis points negative due to that. But look, what we did smartly was we initiated cost optimization initiatives. We did a mark to market of our employee benefits, mark to market of our various policies to the best in class. And that's what we have done in the quarter one. We have taken certain hits in the quarter one so that as we get into quarter two, we are able to absorb some amount of this wage hike, hit that we will be seeing on the margins. So our endeavor is to deliver better than what would have been normally hit due to the one-times or the wage hit that we have taken. As we move ahead, the cost optimization initiatives that we have put in place, the revenue enhancement that we are seeing, all of that will pan out well. Our quarter four exit from a margin run rate should give us the cushion to bring the overall year at near 14.5% plus or minus, and then give us a run rate which is much better than that for the next few years to come. So structurally, we have done what we need to do, and we are on that path to improve our margins, as we have been saying on our earning calls and even in our media interactions.
Well, some important clarity coming in as far as the margin trajectory for Persistence is concerned. Let's now slip into a short break. When we return, we will discuss the market technicals with Sandeep Shah of SBI Securities. Stay tuned.